We're going to shift our attention towards crypto, Tyler, because we had that massive six-figure print in crypto prices back above that 100,000 mark, as you can see there. This is all after prices backed off a bit since first crossing that level earlier this week. Now, with interest as high as ever in the cryptocurrency, this is indicative of why you might want to use a more risk-defined way to play Bitcoin prices so you don't expose yourself to as much of the volatility. And maybe options might be the way to do that. So joining us now is Dennis Davitt, Chief Investment Officer at Millbank Dartmoor Portsmouth. Dennis, you have been an options guy we've looked towards in the past for this. Why exactly would you use options to play Bitcoin? And is it using those options on ETFs the most efficient way to do it?
Yeah, I mean, had you asked me this question 2 years ago, I would have, stargazed at that point because I would not have known where to go, what exchange to trade these on. But there's just been a sea change with the ETFs being listed and now options on those ETFs. So I've been an options trader my whole life. And there's a real transformation going on right now as Bitcoin, the IBITs of the world are out there and the options are trading on those, that you can remove you get a lot more clarity into what you're buying and selling and who you're buying and selling with. The options being traded on these, the crypto world, I get a lot of grief when I'll get more phone calls after this, but the desire to own upside in crypto world far outweighs the desire to own a hedge. And I feel as when I talk to more pension funds and endowments that are looking towards this space, they're more concerned. They're not looking for the 100% annualized return. They're looking for dipping a toe in the space, but how do they do it without blowing up the allocation? And when you look into the options that are traded on these, you can do things where you sell a 3-month up 20% call, and you can finance that by buying it down. You can buy it down 10% out of the money put and finance that by selling a 20% out of the money call. That is completely inverted to what we're used to seeing in the equity markets. And that's just a real transformation as we move out of a pure speculative play in Bitcoin and it moving more into an asset class that people want to own for longer term and lower the overall volatility. So in 3 months, you can participate by buying the 51 put and selling the 68 call. You're in it for 3 months, up 20%. You can annualize that. You're participating in an 80% return for every 3 months you reset this trade. And the key is you take in a little bit of money to do this trade. So it's kind of like a free insurance policy with great break-even analysis on it. I mean, you'll rarely see a trade like this, maybe in some high-flying tech stocks.
Dennis, we're showing the graphic right now of this. What we're showing is a sell of a 68 call, but you're bringing in $3.20, but you're buying the February 51 put for $3.50. It says it's a credit spread of 30 cents, but it looks like you're actually paying out 30 cents. Right. Is that correct?
Yeah. It depends on when you take the snapshot of this. So
gotcha.
Right when the data was sent in earlier, like you said, we were trading below 100,000 in Bitcoin. Now we're trading above 100,000. So you'd have to pay a small 30-cent fee here. But had you done the trade earlier today, you would have taken a credit in.
So I just want to make sure our viewers see that, because the graphic that we're showing says it's a net credit of 30 cents. And based upon what we're seeing there, it should be a net debit or a 30-cent outflow for each of these, for each of these moves. And so I just want to make sure that the graph.
So if I do what Dennis, you're telling me to do, what is my upside profit on my invested dollar, and what is my downside risk on that invested dollar?
Right. So if you went out and you invested in Bitcoin, or you buy the ETF on Bitcoin, you will participate in the gains on that Bitcoin up to 20% between now and February 21st. Above a 20% rally in Bitcoin, you're out of the market. If the cryptocurrency were to collapse, you are completely out of the market, down 10%. You won't lose more than 10%.
I see.
Plus or minus whatever that small premium that you either collected or paid based on the graphic.
So if I put in $100,000, which would buy me effectively one Bitcoin, my maximum gain on this would be to 120,000.
Yep.
And my maximum decline would be back down to 90,000 if the crypto craters.
It's in essence a collar. You give away the upside and you
protect
like a stop loss
exactly,
and a stop gain
by the time it's done. So
all right.
Right.
Dennis,
characteristically,
yeah, I was just going to say, just a final thought here from you on this.
yeah, just characteristically, you could never, it's very, very rare that you can have that kind of trade-off in any other sort of asset class. In equities, even bonds, it's more like you have to pay more for the insurance to the downside.
All right. Dennis Davitt, thank you very much. Good to see you. Have a nice weekend, sir.
I was lost there in the middle, Dom, but you dug me out of the ditch.
Yeah, because I was showing the graphic showed it was a credit. I was like, no, wait a second. You paid more for this than you took in, at least with that price.
I have to think hard when it comes to options. I really have to think hard. I know you did this.
Those options traders out there are smart guys. I did it very briefly in my career, and it's a tough market for sure.
Have a great weekend, my friend.
You too.